Hi, welcome to your accounting class. I am your accounting teacher. This is our first video accounting class. The structure of our classes will be based on the normal textbook school syllabus. However, as time goes on, we may, as a matter of necessity, tackle some questions based on popular demand or some sort of events. Therefore, our video class today shall focus on Introduction to Accounting. This video is for secondary school students, university students, professional students, accountants, entrepreneurs, and the likes. Before we delve into the subject, we need to understand what accounting is. In that sense, we have to also know what bookkeeping is all about. Bookkeeping is the act of keeping records in a regular and systematic manner. It involves the recording of financial transactions, which involve exchange of money or its worth to and from trading activities. Bookkeeping is an entry point of information into the accounting system. Therefore, accounting involves the keeping of accurate records, measuring them, classifying, and summarizing of financial transactions or events in terms of money and reporting the result to the management and other users of accounting information. By measuring, we mean putting a value on those information or those transactions. By classifying, we mean classifying them into different kind of classes of account that we are going to discuss in subsequent lectures. Users of financial statements. One of the users of financial statement is the management. The management use the financial statement or report to evaluate the performance in terms of profitability of the company, to know the details of assets, and also for planning purposes so that they can plan for future and grow the business better. Another user is the employees. They need this financial information in the financial statement to know their job security, and in some cases for wage negotiation based on the performance of the firm. The next user is the shareholders or owners of the business. These are the people that contribute money to fund the business. The shareholders are the providers of capital, so they need to measure the performance of their organization in terms of profitability, determination of share price, and return on to know their return on investments. Another user is the trade creditors. These are those people that give goods and services to the enterprise based on credit level, on credit, and they need to look at the financial statement to determine the organization's liquidity and its ability to settle these debts when it is due. The other users are the financial institutions, which include banks and insurance companies. The banks can use the information to determine the ability of a firm to repay loans and overdraft, and also to know the value of the collateral securities the company is willing to tender. For the insurance company, they use it to know the value of assets to be insured. Another user of this information is the government or tax authorities. They need this information in order to determine the amount of tax payable by the organization. The public too is a user. They use the information to know appraise the financial performance of an enterprise for investment and social responsibility purposes. The auditor is the last but not the least on the list. They require this information, financial statements, to form their independent opinion on it, so that they will use it as a basis for their audit reports. The basis of accounting. The true purpose of accounting is to maintain proper control of the finances of the business. Accounting must be based on careful and efficient double entry bookkeeping. The early accountant used a book called the ledger. This is still the most important book of accounts, since any transaction that must go into the accounting system and form part of the financial statement must go through the ledger. This is the specimen of a ledger. The ledger has two sides, the debit and the credit side. The left side is the debit side, while the credit side is on the right side. At the top corner on the right side, you see L1, meaning ledger 1. The ledger numbering is based on the book. The first page is ledger 1, the second page ledger 2, and like that. That's how you number it up till the number of accounts you are going to have in your business for that period. Now, the double entry bookkeeping, it means in double entry principle, every transaction involves two parties. Transaction is every piece of business activity that involves exchange. Two parties here mean the giver and the receiver. And in any transaction, it is either you paid for the transaction or you carry it out on credit. If you paid immediately for the transaction, it's called cash transaction. But where there is time lag between the contract for the goods or services and the payment for them, then it is a credit transaction. Thus, for every transaction, there must be two accounts. Two parties, two accounts. Is the party that is receiving the value is debited, while the party that is giving the value is credited. Therefore, the rule of double entry is always debit the account that has received goods or services or money. Always credit the account that has given goods or services or money. So what we are saying is, for every transaction there has to be a balance. It's like a scale. The amount on the left side is always the amount on the right side. There must be a giver and a receiver. The scale balances at all times. Example: on January 1st, 2019, Ojerinde contributes the sum of 200,000 as capital for the business, placing it in a bank account with one of the big four banks, say Clanisa Bank PLC. This is the suggested solution for that question, for this transaction. How do we post it? But before we provide the solution, you have to look at the question first and identify which of these two accounts are going to be the parties or the accounts that are going to be involved in the transaction, that are going to be used for the posting. If you read through, you see that the sum of 200,000 was paid as capital, so we have capital accounts. Then it is paid into the bank, we have bank accounts. So those are the two accounts. So you open your T account like as this, side by side. Then we write out the labeling, debit side, bank account. Then you have your credit side. The other one, you have the debit side, capital account, you have your credit side. Then you put out your Naira sign there, and this is just an extract. It's not going to be a complete set of accounts. There's not going to be balancing. We just post only the information that is given in the question. So you have 2019, January 1st. What is it? We are posting. What are we posting into the bank is what? Capital. So you write capital there. Then how much is the capital? Is 200,000. In the other side, that is the receiver now, is debited. Now the giver is going to be credited, which is what you credit capital account with what? You write the date 2019 January 1st, bank, and you write the amount 200,000. That is the whole of the now you look at here, you see L1 at the top here. It means this is our first transaction in our business. So the bank account is our first account, is our first ledger. This capital account is our second account, is our second ledger. It's going to be in the next page of the ledger. Note that the proprietor is always treated as quite different from the business. This is why the money he brought into the business was credited, because he's giving out the money to the business while the bank is receiving. So the proprietor is like a creditor to the business, while the bank is like a debtor to the business. So this is what it means. This is one of the important principles of accounting that we are going to discuss subsequently. Now, thank you for watching our videos. For more accounting video classes, subscribe to this channel. Thank you. God bless you.